Good morning, everybody. Thank you very much for joining us today. We hope that you're all doing very well. If we could go to the first slide, Marissa. So, 2 months in, we hope that your businesses are doing well. We hope that you're coping with Brexit and you're getting your goods in and out of Europe. We've heard some good stories, and that's fabulous to hear. But unfortunately, we've heard that from a lot of our clients that they are encountering significant problems getting their goods into Europe. Their goods are being stopped at the port. Maybe they don't have the right paperwork, or they don't have the right customs representation. The VAT issues are catching people out. They're being charged a lot of VAT, and without the VAT registration requirements being dealt with, they've got little hope of coping back, sort of reclaiming that VAT. And then there are other commercial issues that are dictating how people are doing business in Europe, and contractual obligations. There may be significant problems with health certificates, as we've heard on the press, CE markings, and other EU regulatory requirements that Andrew's going to be telling us about, that are going to be making you think about the longer term position that you have within Europe. So next slide, please. Today, we are going to be talking about a quick refresher on some basics and identifying the common issues, the problems that we're hearing about time and time again, and some do's and don'ts to go around that. Going to have a little focus on the rules of origin, because that really is so significant, and there's a lot of misunderstanding about those. VAT issues, really now focusing on those. We're speaking to a lot of clients about how to deal with these, as well as an update on what's happening with the Northern Ireland VAT issues at the moment. We're going to have an update from Andrew on some significant changes coming in March, the end of this month. I can't believe it's March already, but important things that might then also influence the longer term decision. We've got Chris joining us today to look at what to expect if you are now considering going down, setting up in the EU, and what that actually means. And we've got some good examples of real life situations and how clients and businesses have got around this, what the solutions are, and how we can deal with those problems within Europe. So if we go to the next slide, we'll kick off with just a refresher of the basics. This is nice and straightforward and simple. It's postponed import VAT accounting. It's a wonderful measure to mean that you don't have to pay import VAT to clear your goods through customs. It also, into the UK, it also means that if you have a VAT and duty deferment account, you may not need it any longer. If your goods are duty free because they are EU origin and you've got postponed VAT accounting, there's nothing to pay. So you can have a look at whether or not you still need to keep those arrangements in place. One misconception is that you need to apply and get authorization to use it. You do not. You need to instruct your customs agent that you want to use postponed VAT accounting, and then everything's done by you on your VAT return. You do have to download a monthly import VAT certificate from your normal government gateway account. You go into that, sign up to postponed VAT accounting, which will give you this access to the monthly VAT certificates, and then that is accounted for on your VAT return. In boxes 1 and 4, nets the VAT off down to nil, and it applies to all imports, not just the European Union. So if you're importing from the rest of the world, you can use this as well. Just a reminder that to claim back import VAT, you need to be the owner of goods. We've had a lot of clients talking about repairing goods, or maybe they're hiring goods and they want to be importer. There is some complexity around that. But the basic rule is you need to be the owner of the goods to recover that import VAT. People have been saying to us, well, what does it all look like? And on the next slide, you'll see an example of the type of certificate that you will download from your government gateway account, and then you print this off and keep this as part of your VAT audit trail. So that's the postponed import VAT, which we've had a lot of queries and is something that I think is a great measure. And so let's start off with something that's really good and nice and should be able to be dealt with quite quickly. Let's now talk about the paperwork and the dreaded commercial invoice. Andrew is going to talk us through this.
Thank you, Alison. Yeah, so one of the things that we're sort of seeing issues with is the information that goes on a commercial invoice. So previously, you'd issue an invoice for the sale of a product into the EU. Now you have to issue a commercial invoice, or have the information that's required for a commercial invoice to be able to ship those goods across into the EU. This is required for customs purposes. That's why certain information is needed to be able to declare those goods, both at export and at import into the importing country. So obviously details such as the seller's details, so name, address, EORI number, buyer's details, again, name and address, or delivery address if they're going to a separate delivery address as well. The date of the issue of the invoice, and obviously the invoice number. Description of the goods, so name, product code, commodity code, so enough information that allows for those goods to be correctly declared. So not just a product code without any other information. That doesn't really help anybody, and it could potentially delay those goods being declared both at export and at import, because further information is required. Unit of measure, so if it's in packages or units or kilograms, etc. Quantity of goods. The unit value and the total item value, so making sure that the correct values are shown. Any discounts are clearly stated, because that could affect how the value is determined at the time of import into the importing country. The total value and also currency needs to be clearly stated, because if that isn't clearly stated, there's always a risk when the goods are imported that the wrong currency is shown, either GBP, euros, etc. Terms of payment, so the method of payment, any discounts, like I said, should be clearly stated so that the correct value can be ascertained for customs purposes. And also the terms of delivery, so the Incoterms need to be shown, so that it is clearly confirmed who's responsible for what when those goods are being shipped. And also the means of transport, so is it going to go by road, air, sea, etc. So that's the commercial invoice, and that's where we're seeing certainly some issues in terms of things like commodity codes, certain agents requiring the full 10-digit commodity code to be listed on the invoice, when for exporting purposes you only need 8 digits in the UK, but they're requiring that 10-digit code, which means clients are having to adjust their systems to be able to continue to export those goods. So we are seeing various issues relating to the information that goes on the commercial invoice and what the commercial invoice looks like. So if we move on to the next slide, Marissa. So this is just a sort of basic example of what a commercial invoice would look like, the format of it, the sort of information that's required to be able to get those goods declared to customs. So it's a little bit more information than just a normal sales invoice. But if there's any queries on the format that you currently have, then we can certainly help you with that. So that's the commercial invoice.
Thanks, Andrew. So we have seen with those commercial invoice, the problems we're seeing is that people are maybe sending their goods off with just a normal sales invoice, and that just isn't enough, and that's why it's getting, one of the reasons why it's getting knocked back at the border. The other big issue that we're finding is customs representation. So a little bit about this. EU customs legislation allows two different types of representation, direct and indirect representation. And it's governed pretty much by either the importer or the customs agent needs to be established in the EU. So as a UK business, if you're not established in the EU, then you have to default to the indirect representation. And we're finding that a lot of businesses are going through the VAT registration requirements and doing a lot of the actions they've got to, but this is where they're falling down, because the agents are trying to sign them up for direct representation, and that just means that they will not be able to clear their goods. When businesses are then asking them to act as indirect representative, because the agent is jointly and severally liable for the customs debt, we are finding that, contrary to what was happening before Brexit, a lot of businesses are being knocked back and they will not be represented. It's like an indirect representative seems to be like trying to find a unicorn at the moment. It really is. It's one of those issues that it shouldn't be a problem, but it really is the problem. So please be aware that if you are selling within Europe, this is the type of representation you need. And please don't go down the route where it's a direct representative and then you're in that sort of contractual obligation, but you don't have an entity, because it won't work. So that's a really important problem that is being faced by UK businesses. Andrew, have you got anything else to add on that?
Yeah, where we're finding this sort of issue is with DDP shipments, so delivered duty paid, where you are classed as the import of record into that country. Certainly, Germany have taken a hard line on this and not allowing DDP shipments where you're sort of not got an establishment in that country. So we are seeing an increasing number of cases where companies who are having to operate under this sort of mechanism just because it's their supply chain, they can't get around it, are being pushed back and not being able to get their goods in because they can't appoint an indirect rep. So I think it's a growing situation, and obviously the more companies that need this, the less agents there are that are going to provide this. It's going to cause a knock-on impact with supply chains.
And I think then we've got, if we go on to the next slide, we're into our do's and don'ts, aren't we?
Okay, yeah. So in terms of what you just need to make sure you do is ensure that you've confirmed your Incoterms. A lot of companies we've spoken to the last sort of 4 or 5 months who have not traded internationally before have not really confirmed their Incoterms. So it's just looking at the how you're going to trade, what you're going to be responsible for, discussing with your business partner on what Incoterms you're going to agree to, and then obviously that formalises whether what customs requirements you're going to need to meet. DDP is the obvious one that we're finding issues with, because you as the seller are the exporter and also the importer into the other country, and it's confirming with your agent before you start doing those shipments that they will act as an indirect rep, because if you don't confirm that, then the goods get shipped and they haven't agreed to that, then the goods won't get cleared. It's as simple as that. The other issues to look for are making sure that you do check your commodity codes for all the goods that you both import and export. It's a requirement by HMRC anyway to know what your commodity codes are and to be able to comply with the regulations, but it's understanding what your goods are. Check the customs tariff so that you know what the duty rates are, because that has a knock-on impact with costs and everything else, because duty is not reclaimable. Then we're looking at origin. So if you're the exporter of those goods, you as the exporter, if you're sending them as UK origin, need to make sure that you know what the origin is. You have the backup information, things like suppliers declarations, etc. So don't just accept, well, we manufacture it, they're UK origin. There are complexities to the rules, and they depending on which part of the tariff you use, they could be it could be affected by that. So you need to establish the origin and what information you need to retain in your records. And finally, looking at certifications and licenses. So because we're outside of the EU now, you might need an export license for things like dual use goods, military goods, etc. And also there's the added requirement for things like phytosanitary certificates, export health certificates. So it's making sure you understand what your goods are going to be liable to get them into the EU. Okay, so if we move on to the don'ts, ideally only use DDP unless there is no alternative. We appreciate that a lot of companies, to keep that supply chain and keep the customer benefit, then DDP has to be used, but it's just understanding your obligations and setting up everything so that you can continue to operate DDP shipments. Don't leave everything to your agent or haulier. You've got to make sure that you understand the process and don't just accept, well, the agent and haulier will do all that work for you, because there is a likelihood that there will be potentially something go wrong. And finally, don't promise something you cannot be delivered. Obviously, making sure that you know you're going to get the goods to point B in a certain period. It's not going to be as quick at the moment as it was before the 1st of January, but it's just making sure that you can get those goods to that customer in a timely manner and with minimal issues. Okay, so that's the customs do's and don'ts.
So yeah, so thanks, Andrew. So those common issues are that we are finding time and time again. It's the commercial invoice, it's the customs representation, it's been forced into DDP, which we understand it's the commercial reality of life, but that brings with it all these representation issues. We've had we've had examples, haven't we, Andrew, of where things shouldn't be checked, but they are being checked, and differences between the different member states.
Yeah, so it's obviously we think of the EU as being one entity, but actually with the 27 different member states, they've each got their own different legislation. We're seeing sort of pharmaceutical goods being checked at the border, physical checks, so they're being stuck and held there for weeks on end because those countries are requiring that work is carried out. So yeah, you could import into all the different member states, and each one there'll be slightly different requirements, and that's what companies I think are starting to identify as part of their supply chain process.
And then it's a case of stopping to think, look at the bigger picture. Can you put them through a different country? Is there an easier way of doing this? Can we have one point of entry? All of which we'll look at in greater detail in a little bit. I think as well, the other big problem is misconception about rules of origin, which we'll come on to. But I think now, Andrew, you've got some news about some big changes that are coming in from the end of this month.
Yeah, so from the 31st of March, there will be big changes. So if we move on to the next slide. So from the 31st of March, there was temporary agreements between the UK and the EU because of the short time frame with the trade agreement being announced, that there'd be a 3-month lead-in period for certain things. One of those was for export of goods for the retail sector to Northern Ireland. So there wasn't a requirement for export health certificates up until the end of March, but from the 1st of April, those export health certificates will be required. That means creating a health certificate in Great Britain to get the goods into Northern Ireland. There'll be a requirement for vets to sign those off both in Great Britain and in Northern Ireland when the goods get to the other end. Physical checks on certain goods in Northern Ireland before they can be cleared, because they have to meet EU legislation, not Great British legislation. There were negotiations on the 24th of February, but they've stalled. But the UK government are planning to announce a new operational plan for supermarkets and their suppliers in the sort of coming weeks to sort of establish how the new process is going to work. So it will supposedly finish on the 31st of March unless they can agree to extend it. But like I said, the UK are due to announce an operational plan in the near future. So that's on the retail agri-food. The other one is to do with chemical registrations. So the UK is no longer has access to the EU chemical database, so REACH. So UK companies will have to transfer their registrations for those chemicals to an EU company before the 31st of March. If that's not completed, those chemicals will no longer be able to be placed on the EU market. So if you are involved in the supply of chemicals into the EU and you haven't done this, please make sure that you get that done before the 31st of March. Otherwise, you won't be able to put those goods onto the EU market. Okay, so moving on. The other one, again, to do with Northern Ireland is parcels. So there was a temporary arrangement for parcel operators to not have to do certain things, but from the 31st of March, customs entries and additional documentation will be required to get those goods into Northern Ireland. Also, B2B parcel shipments over £135 will require a customs declaration via TSS within 3 months of receipt. So there is a sort of a time scale in which to do it. It's not immediately, but there is still a requirement to do that. So it's important points to think about. 31st of March, there are changes to how we will continue to operate in trading with both the EU and into Northern Ireland.
Yeah, okay. That's quite scary, isn't it? Because things have been happening, and maybe things have got into different countries without too much hassle, but that doesn't mean that it's going to stay that way. And I think another point that's going to really come hitting home soon are the rules of origin. So the free trade agreement contains technical details about when goods can be treated as duty-free. I think there's been quite a large misconception that the free trade agreement would mean that goods could move freely across EU borders, backwards and forwards, duty and VAT free, like they did before Brexit, and that was never going to be the case. The reality of the free trade agreement is that you get one shot at this EU or UK origin. You can't bring them backwards and forwards into the EU and then back out, so into the UK and then back out into the EU and still claim that duty-free treatment. So Andrew's going to tell us more about and give some examples about what he's finding with businesses and customs warehousing and transit, and how they may solve problems. Before we go on to that, though, I think there's a next slide which is talking about, which is an important thing that's come up. If you have goods in the EU and you're going to export those goods from the EU and you want to take advantage of the fact that they are EU origin goods and therefore duty free, as a UK business doing that, you need to be a registered exporter. That's how the EU denotes its origin. So previously it would be EUR1 forms, now it's REX authorization. A really important point to get across to you is that you can only have a REX number if you are an established business within Europe. So that's just something to bear in mind if you are going to need to export goods from Europe. So then on to the details about origin with Andrew.
Okay, yeah. So one of the things that we've sort of that's been in the press has been sort of goods moving from the EU into the UK and then onwardly supplied, say for instance, into the Republic of Ireland. If goods are sort of brought into the UK free circulation, that causes an issue with the origin. There are ways and means to be able to minimise that and retain EU origin. But we'll have a look at those in a moment. So in this particular scenario, we've got a UK company importing clothing of Italian origin into Great Britain. So as part of that process to get the goods into Great Britain and claim the 0% duty, a valid statement of origin is required on the commercial documentation. So the goods can be imported, 0 tariff as opposed to 12% duty. In this particular instance, those goods are then sold back to an EU retailer. Because they've been put into free circulation, the full rate of customs duty is applicable on those goods when they go back into the EU at 12%. It's the free circulation bit. It takes it out of EU customs control. It becomes, although it retains its EU origin, it loses its EU customs status. So therefore, the 0% cannot be claimed when it goes back into the EU. So if we move on to the next slide, possible solutions. So the first one is you could, if you've got enough availability to do that, is hold stock in the EU. We have seen companies decide to split their sort of requirements so that they hold stock in the EU and also for UK purposes store their UK goods in the UK, so that you can hold stock in the EU. It won't be subject to customs formalities, but there is the potential liability to be VAT registered in the EU to conduct those sales. The other alternative is to set up a customs warehouse in the UK or use a third-party customs warehouse, but you need to use transit arrangements. And the transit arrangements allow for the EU origin to be kept. So importing from the EU using a T2 transit document, the goods get stored in that warehouse. When the export is generated, there's an export declaration, but also a T2 transit document that refers to the original T2 transit document. So it all links together. In that respect, the goods retain their EU status and won't be subject to any EU customs duty, only the VAT. But obviously there'll be a requirement to either hold a customs warehouse, but possibly authorised consignee, consignor. So it's not, well, we can import these goods in, do this and then export. There is the requirement for authorisations from HMRC. So it's an added cost to that. but there is a way of being able to retain EU origin. Okay, so that's those finished goods. The other one that we're seeing a big issue with is double duty. So in this instance, you're importing 5,000 pairs of men's shoes from China. So 8% customs duty is paid at the time of importation. So that's a cost to the business that they can't reclaim. At the time of import, you might not know where those goods are going, but you might sell them into the EU. So in this instance, 1,000 pairs of shoes are sold to an EU retailer. Because they're non-EU origin, they will be liable to 8% duty when they go into the EU. So potentially there is 2 lots of customs duty, so 16% duty on getting those goods in. So that's double the amount of duty that would have been paid before the 1st of January. So if we move on to the next slide. So in terms of solutions, again, same sort of thing. You can either, what we're seeing is companies are splitting that stock requirement, so they're holding stock in a third-party warehouse in the EU, so they can be directly imported into the EU to provide to EU customers. That means that there won't be any liability for any double duties. It simplifies the issue. There's only one import declaration, but again, a company will need to be VAT registered and possibly require an establishment in the EU because of the requirements for labelling, etc. The other alternative is to have a customs warehouse in the UK. You can import the goods, store them for an unlimited time, and then re-export into the EU. So the duty liability in the UK is discharged once those goods are exported from the UK. So you only pay the customs duty once. But obviously, there's the cost and the requirement to have potential authorization with HMRC if you don't use a third-party customs warehouse. So there are ways and means of avoiding the double duty. But it's making sure you do set these motions up in your supply chain. Okay, so moving to the next one. So obviously agri-food goods imported from the EU. So from the 1st of April, this is when the stages start to kick in. So the big one is the requirement for export health certificates. So if you've got lorry loads of animal origin or processed fish products from France, up till now, there's not a requirement for any certification, but from the 1st of April, all of this will need to be in place, and it's not a straightforward situation. So the goods can only be imported from an authorised establishment because they need to have approved processes, etc. Prior to the shipment, an export health certificate will need to be generated to cover those goods, and it could be that there'll be different ones because they're products of animal origin, fish products, vegetable products. They all have different export licenses because they're specific to those goods. So you could have a load where you have 10 or 15 different export certificates. They need to be done in advance. Go to the local authorities, so the French authorities, to get them stamped and approved. But they need to be put onto the Traces system, which is an EU system. So your supplier will do all this work for you. But like I say, it needs to be stamped by the vet so that those goods can be sent for export. So if we move on to the next page. So once the certificates have been sent to the French authorities, they check to make sure that they meet the UK requirements. And once that's been accepted, the certificates are sent to you as back to the seller. They then need to be provided to the haulier, and an electronic copy needs to go to the UK buyer so that they can put that onto the new IPAF system. So this is a new system specifically for this type of movement. You need to register it if you're importing these sorts of goods. So you need to do that before the 31st of March so that you can be able to pre-notify the UK authorities. Once all that is done, the goods can then actually be shipped. So there is a lot of work now going to be required just to get those goods to be made available for export. So it's if you're involved in that sort of thing, it's being aware that of setting an IPAS registration and making sure that your French seller has all the processes in place to be able to do this work for to get the goods across the border. Okay, so that's the agri-foods imports. One of the other things that we're seeing a lot of uptake on is inward processing. So a lot of goods come into the UK for processing. To be able to avoid any sort of potential for double duties, you can use inward processing to do that. So if you've got parts that come into the UK from all over the world, China, USA, or Europe, you can manufacture them in the UK and be approved for inward processing. So in this particular instance, this machine is manufactured in the UK and exported to a customer in the EU. So what are the issues for the exporter? What do they need to do? So if we move on to the next slide. The first thing to do is, are they UK originating? So confirm against the rules of origin on the trade agreement. Is the finished product UK origin? Do you have the evidence to make sure that finished product is UK origin? If it does, those goods can be shipped to the EU as a 0% because those non-originating products have been processed sufficiently and that finished product meets the rule of origin. Are there any restrictions to importing this product into the EU? As we've seen before, there are a lot of regional restrictions in terms of certain types of goods. So it's just best to check with a local customs agent to confirm if there are any licensing or registrations required. If not, the goods can be shipped. What customs duties will be liable? So if they're UK origin, the export can be completed under a statement of origin on the commercial invoice, and therefore 0% duty will apply. If not, these particular goods will be liable to a full rate of 4.7%. Okay, so if we move on to the next slide. So what can you do? So to minimise any duty liability, you can apply for inward processing. So all the components that come into the UK can be processed. The one good thing about the EU-UK trade agreement is it allows inward processing and preference at the same time. It's one of the few trade agreements that the EU has that allows that. So you can be approved for inward processing, import all the components, not pay any customs duty or VAT, make it into a finished product that qualifies for UK origin, and then you can ship that UK origin product under a statement of origin, and therefore there's no duty liable in the UK or in the EU. So that would save a company and the whole supply chain any liability for customs duty. So if you are importing goods that are for process and they do meet the UK rules of origin, apply for inward processing, and then there's no liability for any customs duty. Okay.
Thanks, Andrew. There's a lot to take on board there. We fully appreciate that. And this is just stage one. This is just getting the goods in and out of the UK. So let's now talk to Marissa and Jonathan, who are going to talk about everything around VAT within Europe. Thanks, Marissa.
Thank you very much, Alison. Okay, let's start with a few basic principles of VAT, but which are very important in order to business with the EU. Okay, the first one. Okay, it moved to a strange slide. Sorry, guys, there's one slide missing, but I will tell it without slide. That's no problem, of course. On the slide that was in between, there was there were more details about the following. The first, basics of import. If you are importing goods into the EU, you must be aware that you need to comply with multiple obligations. The first thing is, as Alison and Andrew already mentioned, is that you need to have an indirect customs rep. Once you have that indirect customs rep, plus an EORI number in an EU country where you would like to import goods, you can import the goods. But at the moment that goods are customs cleared in your name, import duties and import VAT will be charged. Import duties will always be a cost and cannot be reclaimed. Import VAT is reclaimable. If you import goods on a frequent basis, of course, you can apply for import VAT deferment license, for example, in the Netherlands. You can do that through a fiscal rep. That's no problem at all. One additional point which I would like to share with you is that as of July 1st, 2021, the EU is going to change its e-commerce legislation. So if you are selling goods to consumers in the EU and you are shipping those goods directly from a non-EU country like the UK to the consumer, you must be aware that the rules are going to change. Every import of good will be subject to VAT. There will be a threshold of 150 euros. If the value of the shipment is above that 150 euros, the regular rules for import are applicable. However, if the value of the goods is below that 150 euros, other rules will be applicable. And what will these be? If you, as for example, a UK supplier, will register for the import one-stop shop in an EU country, the import of the goods will be exempt from VAT, and the sale of the goods to the consumers will be subject to VAT in the EU country of arrival. Now, of course, the question is, how do you pay that VAT which is due in that other EU country? Well, you can pay it through that import one-stop shop system. So that's all new as of July 1st, when you are importing goods coming from a non-EU country and being shipped to a consumer in the EU. Then one other piece which was on the slide was exporting goods. If you have stock in, for example, a country as the Netherlands with a 3PL, and you are selling those goods, let's say, to a customer in Switzerland, the goods will be exported out of the Netherlands and sent to Switzerland. In order to export the goods out of the Netherlands, you need to appoint an exporter of record, because as a non-EU established business, you cannot be an exporter of record. Often your customs agent is arranging that. One other point which must be carefully considered is that if you are selling goods and you are shipping those goods from the Netherlands, let's say, to Switzerland, a zero VAT rate is applied. But that zero VAT rate can only be applied if you have sufficient proof that the goods left the Netherlands and went to a non-EU country. In addition to this, you must make sure that if you are shipping goods from your warehouse in the Netherlands to the UK, because you're a Dutch established business, and you're selling these to consumers in the UK, that you take into account the new e-commerce rules in the UK. These have been implemented on January 1st, 2021, and are very relevant for your business, because the export will be zero rated in the Netherlands, but if the value is below £135, UK VAT will be due on the sale to the consumer. So you must make sure that you have your system set up in order to be able to charge this UK VAT to consumers. Then we are moving to this slide, which is very easy because it's already on. If you have goods in the EU, so you have them with your 3PL, and you start trading with these goods in a B2B situation, you must make sure that you know the VAT consequences of your supply chain. So if goods are moving from the Netherlands to Italy, what are the consequences? If goods are moving from the Netherlands to Germany to Spain, what are the consequences? Can you apply a triangulation regulation, for example, simplification regulation, or not? If you are selling goods multiple times and you're moving the goods only once from Germany to France, what are the consequences? And aside from this, you must also, of course, meet the formal requirements. What are the invoice requirements and what are your VAT reporting requirements? Because these VAT reporting requirements, for example, differ per EU country. Think about the reporting period, think about the payment deadline, filing deadline, etc., etc. And then, once again, as of July 1st, 2021, the EU is going to change its e-commerce legislation. So if you are selling goods to consumers and you have stock within the EU, and from that stock you are selling it to consumers in different EU countries, you must make sure that you meet the new legislation. Because if you would sell goods from your stock to, let's say, a consumer in Germany and a consumer in France, you must charge them with local VAT of the countries of arrival. This means that you need to pay this German VAT and French VAT, of course, to the authorities. Due to the new e-commerce legislation, you can apply a simplification for that. So you can register for a one-stop shop system in the EU country of choice, let's say the Netherlands, and then you report in your one-stop shop return the French VAT due and the German VAT due. The Dutch tax authorities will pay it to the local authorities, and you don't have any VAT reporting obligations in those EU countries. Very important to consider if you are in the e-commerce business that you start preparing for these new changes as well. Then one other thing which I would like to mention is if you are providing electronic services to consumers in the EU as a UK business, VAT is due in all these EU countries where these consumers are living. So if you provide these services and you do not want to register in all EU countries, choose an EU country where you register for the mini one-stop shop system. That's already applicable as of January 1st, 2021, when the UK left the EU. So make sure that you arrange it as soon as possible so that you are still on time for using the MOS system instead of registering in multiple EU countries. Now let's move on to a first example. This is an example where a UK business is selling goods to B2B and B2C customers in the UK and the EU. Goods are shipped from China to the UK, and the goods are customs cleared in the UK. Of course, that's all being done. We see that on a day-to-day basis. If goods are sold to EU consumers, the goods are shipped from the UK to the EU, and the Incoterm DDP is agreed with all customers. What are the issues in this situation, and what could be a solution? We see this situation daily. And what is an issue? What is the first issue, actually? It is that goods are coming from China into the UK are customs cleared, so duties will have to be paid. And then again, when the goods are shipped from UK to, let's say, a customer in the Netherlands, duties are due again. So you have a double duty hit. This could be prevented through, for example, ship goods from China, partially to the UK and partially to, let's say, a warehouse in the Netherlands, wherever you choose. Then you have already a split in your stock. Another solution could be that you ship the goods to the UK, but that you do not customs clear them. That you use, for example, a bonded warehouse in the UK, where the goods are stored under customs supervision. And when you then sell them to an EU customer, and the goods must be cleared for customs in the EU, you only have to pay duties once. One other important thing in this situation is that you agreed on an Incoterm DDP. An Incoterm as DDP means that you as a supplier, as a UK supplier, are responsible for the customs clearance of the goods in the EU. And if you deliver goods on a DDP basis to, let's say, a customer in Spain, in France, in Germany, then you are also obliged to register for VAT in those countries because you applied an Incoterm DDP. That is, of course, absolutely not desirable in practice, and the solution could be to choose one EU country where you will import and customs clear all the goods in your name, and from that EU country subsequently sell these goods onwards and transport these to the rest of the EU. You then only have a VAT reporting obligation in one country instead of multiple VAT registration obligations. Here we are back to the e-services. If you are a UK business and you provide online cloud solutions to consumers in the EU, VAT is due in the EU country of the consumers. So VAT must be paid in these countries. Before January 1st, 2021, the UK company was registered for MOS in the UK. As of January 1st, 2021, the UK company didn't do anything. Yeah, that could lead to a big issue if the UK company is not going to do something very fast, because the UK company needs to pay VAT in all the EU countries where these consumers are living. And if that VAT is not paid, it will run into multiple issues. So what is very important in this situation is that the UK company chooses an EU country where it would like to register for MOS, registers for MOS, and make sure that it pays the VAT due on all these sales to the consumers through that MOS return in that country. Jonathan, a few examples from your side.
Thank you, Marissa. Good morning, everybody. What I've got on the next 4 slides are 4 real-life examples of client issues that we've been dealing with up to and since the 1st of January. Which I felt would be useful as they bring together what Marissa's been going through and also, of course, what Alison and Andrew have covered. So without further ado, the first example, a UK food producer, which is selling and delivering goods to EU businesses, restaurants, wholesalers, retailers throughout the EU. Goods are of UK origin, so we have the statement on origin which can be provided by the UK producer. The key issue for them has quickly become substantially increased freight costs from the 1st of January because of the specialist nature of the goods that they're sending into the EU. I can't quite remember the multiple, but it was considerable and becoming uneconomic for them to sell and ship per consignment to each of their customers. So the solution that's been adopted, everything is labelled up in the UK. Goods are shipped as one bulk consignment on DDP terms, which Marissa's just described. The UK supplier has registered for French VAT and has an EU EORI number. On the points that Andrew was making about health certification, etc., that's something the client feels comfortable with. Indirect representation also seems to have been dealt with. I think to an extent the proof of the pudding will be in the eating on those issues, but so far that seems to work. And then once the goods arrive in France, having been cleared through French customs, they're sent to a cold storage facility, and then they're broken up into their individual consignments and sold to either French or other EU buyers. And perhaps one or two other points on there. We help the client with its French VAT obligations, in other words, what to report on the French VAT return, and also how their domestic French obligations would work as a non-resident business selling to French resident buyers. So there's quite a few levels of detail, but what that achieved was a considerable saving in the costs of shipping goods from the UK into the EU in that example. Next slide, please, Marissa. So this is a business, again, it was in relation to food, buying and selling within the EU, I think from memory, from a Greek supplier to a German customer. So the goods remained within the EU, so the issue was entirely a VAT-driven problem, that from 1 January, when we left the transition period, UK businesses could no longer benefit from the triangulation simplification, which this would be because we've got a Greek supplier, UK buyer, UK vendor to a German customer, with the goods going directly from Greece to Germany, would, before the 1st of January, worked very easily, relatively speaking, by observing the triangulation simplification measures, which would mean that the UK middleman would not need to register for German VAT for the goods that were being shipped there on his behalf. And that's now fallen away, of course. So on the face of it, the UK business, as I mentioned, has a liability to register for VAT in Germany. And we were told, I think just the volume of traffic to the German VAT authorities, on average a 12-week delay. And if this couldn't be fixed satisfactorily, the UK business would lose the contract. And it was a significant ongoing contractual obligation running not just for that one supply, but for a number of years. What we were able to do in this particular situation was discover that another EU country, we could actually obtain through a local fiscal representative a VAT registration in 48 hours, which was done. That allowed the UK business to readopt triangulation for the shipment by using that VAT registration. So Greece to a third EU member state and then into Germany. And that has allowed the business to carry on in business while the German VAT registration is processed so that things are regularized for the contract going forward. Next slide, please, Marissa. So here we have UK subsidiary of a Far Eastern parent company. The parent company manufactures goods and ships them to the UK, and that has been continuing for a number of years. And so the fact that those goods do not benefit from a preferential trade agreement has been accepted. So the first hit of import duty, in other words, is something which is accepted to be built into the price. But 90% of those goods are sold to businesses and also private buyers in the EU, which until the 1st of January was not an issue, because from a duty perspective, that would be the end of it. And there would be, in relation to sales to private buyers in the EU, the only additional issue would be potentially having to register under the distance selling regime. Goods are not UK origin. Andrew very comprehensively walked us through that earlier in the presentation. even though they're duty paid here, that doesn't confer UK origin. So they can't provide a statement on origin. So when the goods are sold into the EU, they'll be liable to duty and most likely, depending on their value, import VAT as well, given the range of selling prices is from 50 to 500 euros per sale. Three potential solutions, and in this case, this is still being explored. One, a UK duty warehouse has been discussed earlier, because that would at least eliminate one of the two duty costs. Second, ship direct into the EU, and then there'd be just the one duty hit in the EU. The difficulty with that, and I think where it's going to lead this business, is potentially that will inevitably lead to, given that what we have in the UK is a hub for EU and European distribution generally, that might actually lead to moving the business from the UK into the EU on a permanent basis. Because holding two levels of stock can get, as you will expect, quite difficult to maintain. And then the last consideration that they've got is, in the meantime, do they ship DDP or DAP, delivered at place, to EU customers? The latter, DAP, leaving the VAT obligation with the customer, and if it's a business customer, the ability for the customer to recover that VAT on its domestic VAT return. So a lot for that company to consider. And finally, example 4. Thanks, Marissa. A UK clothing business. They, again, this is well established commercial practice for them, buy raw materials from the UK, from EU and from non-EU suppliers, raw material being fabric, buttons, zips, all of the material goes into the finished garment. They have a third-party manufacturing plant in the EU, which, although it takes delivery of all of those goods, does not take ownership of them. It's providing purely a service. The UK business, therefore, owns the raw materials and also the finished garments in the EU member state in which the manufacturing takes place. And then the finished garments are shipped from the EU to the UK. And then once they're back in the UK, are being sold to both UK and EU buyers. Hopefully you can see that what we have here are intra-EU shipments and imports into the EU, into the manufacturing, the country in which the manufacturing plant is based, from both UK and other non-EU suppliers. And also, we're going to have duty on the goods going back into the EU, potentially. Now, just to cover the solution off, which sort of covers that last point as well, first thing that the UK business needs to do is register for VAT in the member state of the manufacturer so that it can acquire or import the goods there, because it owns them. The raw materials will be acquired or imported through its local EU VAT number and EU EORI as well, of course. We've established that the finished garments go through sufficient manufacturing to have EU origin status in this particular case because of the level of manufacturing that goes on, but that's quite a high bar to get over in relation to goods which fall within chapters 50 to 63 of the tariff, fabric, clothing, etc. And then when the goods come back to the UK, even though they can come into the UK free of duty, and this was a point that Andrew touched on with T2 status and transit of the goods earlier, there may be a need for a duty warehouse, not to avoid duty here, but to be able to send the goods back to the EU without a further payment of duty when the goods recross the EU border. So quite a lot to think about there too, and we're working through each of those solutions in turn. I think what perhaps this example provides is an illustration of it's never one thing. There's always something else to consider in addition to the first thing you encounter. It's a bit like building a house. You need to do it in the right order. That's it for me. I think at this point I'm handing over to Angela, I believe, for Northern Ireland. Thank you for listening.
Thank you, Jonathan. I am from Bakertilly Minimur in Belfast, and I'm going to cover off how trade with Northern Ireland works post the 1st of January and Brexit. I'm looking really at the Northern Ireland Protocol on a really high level, just as a reminder and a catch up on where we are. So the Northern Ireland Protocol covers different aspects of trade with Northern Ireland, but in this context we're going to talk about goods. Okay, and what it says is that Northern Ireland is part of the EU single market and follows EU regulations and goods. However, it still remains part of the UK and will benefit from any UK trade deals. So on a practical level, what that means is that Northern Ireland has to follow two customs systems. So goods coming into Northern Ireland, the EU common tariff may apply in certain circumstances, and the UK global tariff may apply in others. Similarly, we have to follow two VAT systems. So EU rules apply to goods, and the UK rules will apply to services for VAT. So if we look, first of all, goods coming into Northern Ireland from the EU, there are no tariffs, no tax, no declarations. So those goods can come in from anywhere in the EU to Northern Ireland, as they have been doing before Brexit. So we don't have the issues that GB has. Goods coming in from GB, so goods coming in from Great Britain, there are declarations required on all goods coming in from Great Britain into Northern Ireland. There are TSS declarations, and we'll have a look at the TSS declarations and the possibility for tariffs on those goods a little later on. Goods coming in from the rest of the world, then we need to, customs declarations again will be required in those goods, and there will be a UK tariff or an EU common tariff payable on those goods depending on whether they're deemed at risk of moving into the rest of the EU. That's goods coming into Northern Ireland under the Northern Ireland Protocol. Goods going out of Northern Ireland under Northern Ireland Protocol, it says that there should be unfettered access for Northern Ireland qualifying goods going into GB. So there'll be no exit declarations required. There are a few issues around that in terms of what is a Northern Ireland qualifying good. At the minute, the definition of a Northern Ireland qualifying good is a good that's in free circulation that isn't subject to any customs procedures. So it's a very broad definition. But if you think about it, it is open to abuse, if you like, or open to use, depending on your view from EU businesses. If they were to route their goods through Northern Ireland, does that mean that they can get into GB without any of the customs procedures that they would otherwise have? We know that that's going to be something that's kept refined over time, but it is something that businesses in Northern Ireland are starting to look for clarity on in terms of confirmation that the good that they move from Northern Ireland to Great Britain is a qualifying good and will remain so. So we're going to look at it. Sorry, can I have the next slide, Marissa? Thank you. We've broken this down into looking at the declarations, the tariffs and the VAT on goods going from Great Britain to Northern Ireland. I suppose I would just say at this point, there's a lot of discussion, certainly if you look in the news on Brexit, it's all around the Northern Ireland Protocol. There are certain areas which are still to be agreed or which there's discussions on. So Andrew, for example, has talked about the export health checks. And looking for the extension of the grace period for those export health checks for food. I know certainly we were looking for an extension to 2023. Doesn't look like we're going to get that. There's been some issue around the parcels coming in from Great Britain into Northern Ireland. The main issue is political, and it's a political view that there should not be a border down the Irish Sea, which doesn't give us much certainty while those discussions are ongoing. In terms of the practical piece, businesses in Northern Ireland have actually found the system TSS and the declarations and the tariffs not as difficult as the press would have us believe. It will settle down, we will get used to it, and it will actually work. There are definite possibilities for Northern Ireland, and Northern Ireland could well be used as a solution to some of the issues that Andrew and Jonathan and Marissa have talked about on the double duty on goods, for example. But we need that political stability. So we need, we kind of need that certainty that the Northern Ireland Protocol is going to remain in place as is for the foreseeable future. In terms of declarations under the protocol, it is a new process for traders. There is an electronic import declaration required, and safety security declaration is required on all goods coming from Great Britain to Northern Ireland. The Trader Support Service is a free service that's been set up by the government. It will run for approximately 2 years, and it will undertake that digital process on behalf of the traders. So when it was announced, they announced that they would complete the declarations on the traders' behalf. I think that was a bit of an oversimplification, because there's still significant work required in compiling the information and getting the information to TSS to enable them to complete the declarations. The other issue with TSS is it wasn't actually up and running on time. It is now, I understand as of last week, they are now fully operational. And in most cases, where the delivery is anything other than DDP, so delivered duty paid, as again Andrew and Jonathan have talked about, the initial declaration is generally completed by the supplier in GB or the haulier, and that's an entry summary declaration. And then by the 4th of the following month, the Northern Ireland business will go into the portal and has to complete the information for the supplementary declaration. That has come as a bit of a surprise to some businesses, and certainly the amount of information that's required to complete those declarations has come as a bit of a surprise. Whenever we were told that the Trader Support Service would complete the declarations on businesses' behalf, I think a lot of businesses thought, great, nothing to do, which of course isn't the case. But we've come through the first cycle, and the first declarations, I believe, were only completed last week. The next set of declarations will be due by the 4th of March. And as we move on and businesses become more familiar with those declarations, I think it'll become a routine piece of work. The one piece I would say is that for GB businesses wanting to trade with Northern Ireland, of course, you need an XI EOI number. So that's EORI number. So that's in addition to your UK EORI number or your other EU EORI number. You need a specific XI number to trade with Northern Ireland. Very straightforward to get that. If you have your XI EORI number, register with the Trader Support Service, and they will be able to help you through and take you through step by step in completing those declarations that are required. Next slide, please. Okay, so once we've got over the declarations and the fact that TSS are going to complete them for us, let's have a look at the tariffs that might be due. So the starting point for tariffs and goods coming from Great Britain to Northern Ireland is, first of all, that where the goods qualify under the UK-EU trade agreement, so the UK originating goods, then there should be no tariff on those goods coming into Northern Ireland. There should also be no tariffs on goods coming into Northern Ireland which are going to be used by end consumers or final consumption in Northern Ireland and the UK. Okay, so the first point is, are they covered under the trade agreement, in which case there's no tariff due. If they aren't covered under the trade agreement because they aren't a UK originating product, so for example, the business is bringing in products from China, the UK business is bringing in products from China and then moving them on to Northern Ireland, they won't qualify. If those goods are going to be used by a final end consumer in Northern Ireland, then you should be able to declare them not at risk of moving to the EU, which means then again that no tariff is due. To be able to declare those goods not at risk, that business needs to register under the UK Trader Scheme to say that the goods that they're bringing in are staying within Northern Ireland for final consumption within Northern Ireland, and there are examples of the criteria that need to be met around that. And that allows you to claim them not at risk and not have to pay any tariff. So the only tariffs on goods coming from GB to Northern Ireland should be those non-originating UK products, so the Chinese goods, for example, that have come from UK to Northern Ireland, that we know we're going to sell on to the EU, so we know we're going to sell to Ireland, being the main example. And where we have that and there's a tariff due, then there is a waiver exemption that we can claim. It's only on the tariff and goods moving from GB to Northern Ireland, and is subject to de minimis aid limits. So all of the de minimis aid that you claim will be considered in that £200,000 over 3 years. And if you have claimed less than that, then you can get a waiver on the tariff that's due. Sending parcels to GB, I was going to mention, I think Andrew really has this covered in that that's the other occasion where you may have to do a TSS declaration. So if a business in Northern Ireland has received a parcel worth over £135 from GB, they need to go onto TSS and do a declaration within 3 months. That again is subject to review, and certainly one of the areas that I know there's been a lot of lobbying around and trying to change going forward. So we'll see what happens on the 31st of March with that. Give us the final slide, please. Okay, and just to cover off then on VAT, on goods moving from GB to NI, the first point to make is that it's still one UK VAT return, so there's no separate VAT registration required for Northern Ireland. The one VAT return accounts for all sales across UK and NI. The two main points there are firstly on movement of own goods. So if you have goods that are moving from GB to NI, so you have a depot in Bristol and a depot in Belfast, you will now need to account for VAT on the movement of those goods between Bristol and Belfast, even though there's no sale. And similarly with a UK VAT group, so previously where they have a UK VAT group, there would normally be a disregard on the sales between members of that group. Where the sales are happening between GB and NI, that disregard is disapplied effectively, and you'll need to account for VAT on the movement of those goods. And finally, just to cover, for anyone who was on the previous Brexit webinar, we talked about the margin scheme. So the margin scheme is going to be very disadvantageous for example, second-hand car dealers, in that they couldn't apply it to goods bought from GB. That has changed, and that has been reinstated with effect from the 1st of January 2021. So the second-hand car dealers can now apply the margin scheme to any goods that they buy from GB. The last point I want to make on VAT is on Northern Ireland sales effectively and operating under the Northern Ireland Protocol. I think this is a point which has caused some confusion. So we have an XI EORI number, which is used for customs purposes, and that is used when goods are moving from GB to NI. And then we have an XI VAT number, and the XI VAT number is used for VAT purposes, and it is used whenever businesses are trading under the Northern Ireland Protocol. And it is used for sales to the EU, for example, and it would allow reverse charge to apply. It would allow for triangulation to apply, where goods are moving from, where sales are happening in Northern Ireland, goods are moving into Northern Ireland to be used for business purposes, or Northern Ireland goods are being sold to the EU. You need to tell HMRC if you're entitled to use the XI VAT number. You need to register and tell them, otherwise it's not effective. And the other issue we have seen with the XI VAT number is UK businesses who have been entitled to use an XI VAT number on certain occasions, thinking they can use that for other purchase, acquisitions or sales with the EU. So for example, a UK business buying goods from France or selling goods to Germany cannot use the XI prefix in those circumstances, because it really should only be used for sales or for transactions that are qualifying under the actual Northern Ireland Protocol. Okay, and with that I'll hand back to Alison.
Thank you so much, Angela. So we're concluding our VAT and customs part of our talk. It's back to the checklist basics. It's an evolving feast here, isn't it? It's an organic process. I think that the examples given by Jonathan, Marissa, Angela give you the visualize the bigger picture, and we need to look at that bigger picture now for our supply chains and the pricing, you know, the cost of declarations, the cost of logistics, and see if it needs some tweaking still to be able to cope post-Brexit. And those partners in customs, the representative, all important. If you haven't got it, do we need to change things? And again, back to the contracts with the Incoterms that we've all been discussing. So it's a constant refresh, particularly with the July changes coming up for VAT purposes, and also those March 31 changes that Andrew talked about. If you're thinking, there are just too many challenges here for me to cope with, and I really am thinking now that I need to set up in the EU. Chris has kindly come along to talk to us today about what that really means, so I'm going to hand over to him now.
Thanks, Alison. Good morning, everyone. We've heard some great content there around the transaction side of things, about moving goods. But we're going to move quickly through to the kind of group structure considerations. At a high level, what's going on? A lot of key inputs are coming from various governments saying businesses now need to set up in the EU, which is quite a different change of tone from back in before Christmas, when the deal dropped, that said this is great for business, etc. The first article we're going to put up here from late January, though, does show a slightly different change of tone. UK businesses are being told to set up in the EU to avoid the trade disruption. Sounds like quite a simple step, but there's some serious considerations that businesses need to be thinking about before they make that big jump to having an entity on the continent. Not saying it's the bad thing, I'm just saying be prepared, make sure you're aware of all the key considerations. So starting to get the message here, okay, it's not going to quite be as simple as we hoped and thought, which we all really knew anyway. Moving forward into February, another article drops. All business knew this at the already, but really the Brexit-EU relationship started to get a bit bumpier. Some other real issues were coming to light, real practical issues. Is the solution to set up a subsidiary? We shall see. And don't forget, obviously, as well as all the key goods and transactional considerations, we can't forget about the people as well. The Dutch were really helpful, given that we're in the middle of a coronavirus pandemic, to issuing their really blunt gut direction by providing a checklist for travel to the Netherlands. And for those keen-eyed here, we'll see that the only thing on the checklist there at the bottom is do not travel to the Netherlands. So we've got key people considerations here as well as for groups to think about. Sorry, Marissa. And in addition to the goods elements as well. Okay, so let's assume for a second a UK-centric business for many years is coming through the Brexit process and deciding either it needs or wants to have a UK presence on the continent. But what does that mean? Let's skip over to the next slide to talk you through at a very high level. Once you've decided to set up in Europe, now what? A lot of UK businesses will think, you know, it's super quick, super cost effective, and super simple to set up a UK company. But on the continent, it can be much more complex, take much more time, have much more considerations. For example, the first point, do we want to incorporate a company or just establish a branch? There's varying pros and cons of both, but from a transactional perspective, we're seeing the practical guidance is to go down the company route for various reasons that we can go into on a case-by-case basis if that is useful. We have our Going Global guides on the left available to talk you through, you know, the budget you'll need, the time frame, the other key things to think about should they be beneficial. Then we move into the next step. We've got the entity set up. What registrations do we need regarding VAT? Just in one country, in more than one country? Other tax registrations, other legal registrations. Some countries require trade licenses and other aspects. Local banking is a consideration not to underestimate. It can be a huge headache getting through banking. Know your client procedures, so leveraging existing relationships is key from experience. Are you going to have local employees? What local substance? Is it really just a boilerplate company over there? Really, the epicenter is the UK. That's going to give you issues around substance, around setting up that company, around who's managing and controlling that company. Is it even though it's a Dutch company, for example, could it still be taxable in the UK via management and control? Lots of things to think through rather than just get a company set up to solve this individual problem. Okay. Then we get back into the transactional considerations, which entity is going to invoice clients, which entity is going to make purchases, and which entity is going to hold stock. There's going to be intercompany charges for various either goods or services being provided between the two, which entity is bearing certain risks. We've obviously got Forex, potential bad debt if depends on who's invoicing the customer, who's holding the stock risk, etc., etc. Intercompany agreements are key because from a corporate tax perspective, which is my area, once you have a subsidiary on the continent, who is disclosing what profits to which authorities? How does that play out for shareholder value, etc., etc.? That brings up the transfer pricing considerations to make sure each tax authority is comfortable with the share of income and profits that they're generating. It can be a really, really complex area depending on which countries you're dealing with. And this is a really, really key point. Let's say you've got a really successful UK business, but half of your sales are into the EU. You think, okay, we need to set up a European subsidiary. Let's make all our sales to EU clients going forward through that new EU subsidiary. Very sensible solution. But actually what you're doing is you're disposing of an intangible asset from the UK company to your new EU company. that could have serious tax implications in the UK. Got to work through all of these considerations so there's no surprises down the road that impact the business, impact profitability, and impact the shareholder value. There's going to be withholding tax costs. Unfortunately, the EU can no longer benefit from something that's called the Parent Subsidiary Directive that eliminates dividend withholding taxes. So certain countries across the EU are going to bring in that extra layer of tax that probably most companies haven't even thought of before. Luckily, it's zero in a number of EU countries, 0% dividend withholding tax, but other countries are going to leverage that. So something to think about. And then there's all the key considerations. You've got a new company. What are the local accounting requirements? What are the local tax compliance requirements? And then that impact on the effective tax rate of the group. If we're setting up in Ireland, they've got a 12.5% tax rate, likely to be favourable. If we're setting up in other higher tax EU countries, could have a material impact on that effective tax rate. And my last message to provide to you is, if you're going down that road of setting up in Europe, make sure this process is thought through. You've robustly considered all the key considerations, and allocate this task to someone that is good at paperwork, because the key is paperwork to make sure that this works for the business in the short, medium and long term. Back to you, Alison. Thank
you, Chris. Well, thank you everybody for listening to us today. We hope that our thoughts and our observations are helping you through your Brexit journey, of which it will continue for quite a while. I'm sure we can all see that from the topics that we've discussed today. Thank you very much to my colleagues, as ever. And we're conscious that we do have some queries that have come through on the questions and answers, and we will get back to you separately on email with those. So thanks again. All the best.